Hey everybody, Preston Bryn here with our weekly update. This is the Trader User Group weekly update for the week ending July the 8th, 2022. Thanks for tuning in, everybody. Let's just kind of go through where we are. If you've noticed, I've got a fork in the road. We are coming to a fork in the road. We got a couple of key events coming up over the next 3 weeks as we round out the month of July. So let's just kind of go into them just a little bit. But first, I wanted to just kind of recap where we were from the prior week. So if we look at it, you can see here everybody in the U.S. was in the green. Okay, Dow, S&P, Nasdaq, Russell, all solidly in the green. Still, we're kind of in a bounce in my mind. Year to date, we're solid in the red. Nasdaq, Russell, still in a bear market. The PE ratio, the forward PE ratio, is at 16.69. That's about 20%, almost 21% lower than the trailing 12-month PE ratio. Dividend yield for the S&P has come in at 1.68. Treasury is at 3.10, how it closed the week. So the U.S. Treasury is about 142 basis points, the 10-year, over the dividend yield in the S&P. Meanwhile, the earnings yield for the S&P came in at about 5.25%. And the yield of the earnings, or the earnings yield in the S&P over the 10-year Treasury is about a positive 2.15%. But the real yield is still a negative 3.35 when you factor in inflation. And the current VIX, if you look at the current VIX, last week it was at 26.7. This week it came down just a little bit, a little over 7.7% to close out the week at 24.64%. Best performing sector for the week, discretionary up a solid 4.54%. Worst for the week, utilities 2.83%. And then the annual sector performance, energy still all year as it has been, leading the way at 30.51%. Discretionary is coming in last, 28.13% to the downside. Now, we did see this week that both the global and the ISM data, S&P Global and ISM data released final estimates for the services activity in June, both of which came in modestly above consensus estimates. Okay, but they're still indicating a slowdown in growth. The ISM measure hit its lowest level since June of 2020. Okay, and the employment gauge fell into contraction territory for the third time this year, according to Reuters. This is the ISM services data. All right, but the closely watched payroll data this Friday came in. We added 372,000 non-farm jobs in June, well above consensus expectations. Okay, and then moderating economic data, I think, is going to prompt some investors to brush off some of the hawkishness stance of the Feds that we saw in their June meeting minutes. But it's going to be really hard to tell exactly where we're sitting right now with this. And as I said, we got earnings kicking off this week. This coming week is going to be very strong. As usual for the S&P 500, earnings are going to start off in earnest the end of this week. We're going to get Morgan Stanley and JP Morgan on Thursday, and then Citi and Wells Fargo, Bank of New York Mellon, BlackRock, PNC Financial, and State Street, and US Bank Corp, all on Friday. So a big, healthy dose of bank earnings. We're also going to get the consumer price index for June. That's coming out in the middle of the week as well. The core CPI is expected to hit a 40-year high of about 8.8%. That's what markets are expecting, which was higher than May at 8.6%. Core CPI, which is, of course, what the Feds follow, is expected to cool a bit, but still hitting a high note. So this is going to put pressure on the Feds. We're going to have also, with the earnings coming up, you've got some of the analysts saying earnings are going to grow a lot stronger. Others are saying it's going to pull back. And this is really going to be a good next couple of weeks to see where the markets close out the month of July. I believe from this point here, markets are going to be lower. They're going to be below 3,900, but we'll see. It's not going to take much in the economic data to change that, either the earnings or the Feds. But we do know the high probability play is the Feds are going to hike the rates and growth is going to slow. So you put those two together, and we should get more of a softening in the markets. Okay, so that's a little bit about what I'm seeing. Meanwhile, if we come over to Europe, excuse me, and look at the European market, ECB is way behind the Feds as far as hiking rates. But we're going to see. Most of them are in agreement that they're going to hike by 25 basis points in July, and then they're also talking about 50 basis points in September. Meanwhile, if I can quit coughing here, across the Eurozone, the PPI came in at huge producer prices. The prices now surged 36% in May. Huge numbers across Europe. I mean, it's just really strong. I mean, just it's hard to believe, right? Hang on one second, guys. So with that surge, we're also seeing retail sales volume increasing a little bit as well. But we saw over in the UK, Boris Bulldog Johnson has announced his intention to resign in the UK. So there's a lot of activity over in Europe. And meanwhile, the markets are forecasting that Europe's going to fall into a recession before we do if they're not already in a recession. By the way, this week was the first week of an advance in the European markets after 3 consecutive months of losses. You can see all across Europe, Euro stocks, FTSE, CAC 40, and DAX all finished in the green this week. Still down close to bear market territory, but definitely in a correction, except for the FTSE, it's only down 2.5% or so. So they're having a hard time of it. And then, of course, if we move over to the Asian markets, you can see over there in Japan, sad news on Shinzo Abe. He was the former and longest standing prime minister in Japan. He was shot and killed while giving a campaign speech this past week. And Abe was his signature economic policy, and we made a lot of money on him, especially in the yen, was he kind of had 3 pillars. Monetary easing, fiscal stimulus, and structural reforms. And they're kind of being retained still by the current prime minister, Kishida. But just really a good guy and a solid conservative over there, and just trying to change the economic trajectory of Japan. So we'll see how that plays out over the next couple of weeks. Meanwhile, over in the other part of the Asian world, in China, you can see China was actually down just a little bit for the week. So was Hang Seng. They're down also year to date. But China stocks are kind of coming off the low here as they're easing their shutdown, their COVID shutdown. But they're seeing an uprise in COVID virus again, so that that could affect the way they're running it, because they got a zero COVID policy, which makes absolute no sense to me, but that's what they're trying to run. Meanwhile, the China's Ministry of Finance is allowing local governments to sell more bonds, special purpose bonds. So that's their way of getting money into the economy. So like Japan, China is the only other country that's actually adding stimulus to the economy instead of taking it away. Meanwhile, since they started opening up, we're seeing their PMI data moving up strong, as we would expect once the economy opens back up again. Now, what I'm going to do is let me just shift the screen here for just 1 second. I'm going to move you over here, right, like this. It'll take a couple seconds to come up on the screen for you. But I want to show you a couple of charts here in the E-mini S&P 500 futures. You can see here these little railroad tracks with a gap in the futures where we gap down. We had a rare gap in the futures, and you can see we filled that gap nicely. We're having a hard time getting up a little bit higher, but the 50 EMA is still well north of the current price. It's sitting at about 39.84, so near the 4,000 level. So we got a ways to go to challenge that price. And you can see my original target was down around 37.27. We actually blew through it and came down to 36.39. And now we're moving up. We have no bullish divergence here. So that would indicate to me that any move higher is probably going to be sold off as we move into earnings and we get more clarity around what the Feds are going to do. just to show you another view of this chart, which is, I like it. You can see here, we've had, if I just move it down here a little bit, you can see there have been 7 bull trap rallies this year, averaging about 7.69%. The average day in the bull run is 6 days, and the average point move is 312, 312 points. Okay, so right now we're up about 275 points from the lows. Okay, from these lows down here, right down here, and the width of my Donchian channel is about 15.5%, about 563 points. We're sitting at the midpoint of this Donchian channel here, and you can see how we've been riding this 9 SMA moving average straight up, and the 3 EMA has been riding right on top of it. So we've got a lot of resistance right at this level. If we break through, I'm going to look to see that we have a retest, it holds, and then we move higher. If it doesn't and it rolls back over, the odds do favor a move lower. I will tell you that the markets do favor a move lower as we move through the remaining part of July. That's a little bit about what I'm seeing here in these markets. And if we come down here, and let me just show you the volatility. The volatility's come in nicely. You can see here in this, let's get this back on the screen here. You can see with the VIX, we're now testing the 200 EMA of the VIX. The 50 is over the 200, which is more bearish than bullish, but it's testing it. We've tested it here. And we really I thought we were going to move higher in the markets, but we didn't. And vol started to spike back up again. But you could see where we're sitting here now. We're still solidly around 24.5, 25 in the VIX. Until we get below 20 and maintain it for a week or two, then we're susceptible to these big chops to the upside. Okay. And then, of course, if we look at bonds, bonds is going to have a really interesting remainder of month, okay, in July. Now, our members have made really great money in the bond market and interest rates. We started shorting bonds back in the fourth quarter of last year. That was my recommendation. You can see here bonds have been moving higher, which means interest rates have been moving lower. We're having a little bit of a dip here. I think if it moves up any higher, I'm going to be a willing, active seller of bonds. Right now, the reason why rates are where they are instead of not going through the roof is the markets are starting to price in a higher probability of a recession. Okay, so the 10-year, the 30-year, they're coming down interest rate wise and moving up as a sign that money's seeking safety in the bond market, the debt market. We got to watch this very closely. It could not hold the 50 EMA more than just a few days, and then it gave it all back up again. So we got to watch this very closely. And if we look at the 10-year interest rate, you're going to see here on this that, again, just to the opposite view, we broke the 50 EMA and then we moved right back up again. My original target for the 10-year was around 3.3. We actually hit 3.48. And this would suggest this move lower, interest rates are actually going to move back below 3 again. And if we get earnings revisions to the downside more than what the markets expect, we can expect bonds to move higher, and we can expect equities to move lower, and we're going to see interest rates move lower as well. So something that we're going to for sure see. Now, in the dollar, if we look at the US dollar, it's on a tear. In fact, I don't know if I can adjust it right here. I'm having some trouble with my mouse. But you can see the dollar has made new highs right up in this area right here. And even though we had a little bit of a divergence here that would suggest it's going to move a little bit lower, it just caught wind and went right back up here again. So I can see the US dollar holding on to these gains here as Europe. If Europe goes back into a recession, then it's going to be ugly for Europe and the euro is going to move into a parity with the dollar. And then if that happens, then we're going to see we're going to see the euro move below $1, 1 to 1, believe it or not. So that's a little bit about what I'm seeing on here. And then just now that I'm talking about the euro, if we take a look at it, you can see here the euro now is sitting, I mean, right on my target. I had a target of 1024, and that's where we're sitting. If you can see it right over here in the far corner right here. This was my target, so we made new 2022 lows. Like I said, I'm having trouble with my mouse, so it doesn't seem to be grabbing this and moving things around. But we're hitting my target, so that's exactly where we want to be. I think it could run a little bit lower. I'm not seeing any divergences here on the MACD, so that would suggest this thing could run lower. And then, of course, if we come over here to gold and take a look at the gold futures, we came right down to my target. Remember, I had said my original target was around 1750. We've blown right through that, made new 2022 lows, and now this target is going to be our overhead resistance around 1750. Okay, we had the cross in the 50 and the 200, and as I told you guys, the silver markets had already crossed well before this, and they're just moving lower. And I like silver to the downside. I'm sorry, to the upside, but I'm not ready to pick it up just yet, right? You can see here silver is down below 18. I mean, it closed at 19.23 over here in the corner. But I do see this thing really moving sideways for a while, but we're in a clear bear with silver also. Okay. And then, of course, with oil, and keep in mind with gold and oil, our members, we have a way of trading this, which I think is very good. And it's an easier way to make money trading these. Right here, you can see the choppiness nature of it. I think oil held up on the 200 EMA. It's probably going to run up here, test this, roll back down. So we're in a chop for oil. Okay. And of course, if we look at nat gas, you're going to see nat gas is very similar, right? It's just coming straight down. We've made some good money on this run up in nat gas, and now it's going to be consolidating down around these levels down here. So that's a little bit about what I'm seeing in the natural gas market right now. All right, everybody, that's a quick update for this weekend. Members, I will see you this Sunday evening for our weekly market watch. Have a great weekend, everybody. Ciao.